Hi, the end of the UK tax year is coming up, and this is the last moment to take legal steps that can genuinely reduce your tax bill. In this video, I'll show you point by point what you can still do before the year ends, whether you are self-employed or running a limited company. This isn't about loopholes or creative accounting. These are normal legal solutions used in the UK every year. The problem is that many people only remember them when it's already too late, when the tax year has ended and the tax is due. So today we'll go through practical examples from buying equipment to pensions, courses and marketing, all the way to employing family members or writing off unpaid invoices. Let's start with the basics. How to check where you stand and how much you can still do. Firstly, estimate your profit. If you are self-employed, in simple terms, you can estimate your profit by adding up your income and subtracting all allowable costs. That gives you your profit figure. Based on that profit, you can calculate the income tax and national insurance due. With a limited company, the rule is similar. Income minus costs equals company profit, and corporation tax is calculated on that profit. But let's pay attention to a few important points. In a limited company, what matters is properly recorded transactions, not just how much money you have in the bank. For example, an invoice you issued that hasn't been paid yet still counts as company income. Remember to estimate any income you still expect to receive before the year end and include it in your calculations. For people working in construction industry under CIS scheme, the income that counts is the gross amount before CIS deductions. So if your invoice is for £1,000, but you receive £800 because 200 is deducted under CIS, your income is still 1,000. If you are VAT registered, taxable profit for income tax is calculated using net amounts, meaning excluding VAT. The same applies to costs. You calculate them excluding VAT when working out profit. In practice, the easiest way to check your estimated profit is in accounting software like Xero, QuickBooks or FreeAgent, or by using reports from your accountant. Okay, you know your profit, what next? If you roughly know your profit and estimated tax, only then does it make sense to take action. That's important because sometimes there's no point trying to force extra costs if the tax is already low or there wouldn't be any tax at all. For example, if a self-employed person has a profit of £12,000, their tax would already be zero. Extra cost wouldn't reduce it further. It would still be zero. So pulling those expenses into the current tax year could be wasted. In that case, it may be better to delay some costs so they reduce tax in the following year instead. A similar situation can happen if someone is close to the higher tax band and they expect higher income next year. Then it may be worth moving certain expenses into the next tax year so they can be deducted against income taxed at a higher rate. If you've calculated your profit and it's clear that looking for tax savings makes sense, let's go through specific actions that can help reduce tax. Buying equipment and business assets. This is a classic and it works. If you were planning soon to buy tools or equipment, a computer or phone, replace your fleet or workplace equipment, it can often be worth doing it before the tax year ends, not after. If you buy after the tax year ends, the expense counts in the next year. By bringing a needed purchase forward, you can claim the tax deduction in the current year. Purchases on installments. Many people don't know this, but in many cases, if your limited company buys equipment on installments, you can still get an invoice for the full amount and record the expense in this tax year. And for self-employed people, taking a loan and using it to pay for the purchase can have a similar effect. How does this help with tax? You get the tax deduction for the full invoice amount right away, but the cash payment is spread over time. That helps your cash flow. You get the full tax benefit now, and if you repay over a few years, you keep the money available longer for other uses. Of course, you need to consider whether the credit is worth it, but with 0% installments, for example, you delay payment while still getting the full tax deduction immediately. Consumables and other purchases. If you run a service business, construction, transport, installation, it often makes sense to buy things you'll definitely use anyway, like basic tools, protective clothing, vests, helmets. A simple example. If you have a van and you usually fill it up every 2 weeks, it's better to fill it up on 5th of April rather than 6th of April if you're self-employed. You need the fuel anyway, it will be used, and the cost will fall into the current tax year. But be careful. If you run a shop and you buy goods for resale, the rules are different. The cost of stock is generally deductible when it's sold, so buying stock in advance won't give you the same immediate tax effect. Private pensions. Another very strong topic is pensions. Contributions to a private pension can be one of the best ways to reduce tax, especially if you had a good year. For self-employed people, pension contributions can reduce taxable income. For limited companies, pension contributions can often be an allowable business expense that reduces the company's taxable profit. There are limits, of course, but they are relatively high. It's a big topic, but it's worth remembering because many people leave it too late and end up paying more tax even though they could have set money aside for the future. And the time to act is now before the tax year ends. Courses, trainings, certifications. This is something people often skip, and they really shouldn't. If you are planning courses, training, certifications, or industry events, it's often worth doing it before the year ends. Not every course is deductible, HMRC has rules, but many training costs that are directly related to your business can legally be claimed. By ordering and starting a course before the tax year ends, you can often deduct the cost from taxable income. And it can also increase your income in the long term. So it's not just a tax saving, but a real investment that can pay back quickly. Bad debts, unpaid invoices. If you have invoices that are genuinely uncollectible, you know the client won't pay, and you have evidence, in many cases you can write them off as a bad debt. But it has to be done properly, not just I feel like they won't pay. Reviewing invoices that have been unpaid for many months and writing off some as bad debts can significantly affect your final result and your tax bill. Mileage, working from home, business travel. This is where a lot of people lose money simply because they forget. Check if you've included mileage allowances, business travel costs, working from home costs, parking, business trips. Individually, this may be small, but together they can make a big difference. Cash expenses and expenses paid personally. Expenses paid from your personal account for business purposes or paid in cash are often forgotten, especially when they are small amounts. For example, you parked the company van and paid for parking using your private app. Or you urgently needed batteries for a computer mouse and paid cash in local shop. Often these expenses aren't properly recorded at the time, and over a year they can add up to a meaningful amount. It's worth checking your personal bank statements and making sure all business expenses have been included. Website, rebranding, advertising campaigns. If you are planning a website refresh, a rebrand, an advertising campaign, or other marketing activity, the end of the year can be a good moment to plan and possibly order it. In many cases, these are costs you can normally claim. Buying software instead of renting it. Sometimes it's more cost effective to buy software as an upfront license instead of paying monthly. The same can apply to equipment. Instead of taking a phone on a contract for £70 a month, you can buy the phone and then pay a cheaper monthly plan. The total cost might be similar, but if you deduct the full phone purchase in a current year, that can reduce your tax bill for this year. Company event. If you have an LTD company and you have employees, even a small team, remember this rule. You can organize a company event costing up to £150 per employee per year, and it can be a legitimate business expense. So you can finish the year with a bang, boost team morale, and get tax savings at the same time. Employing family members. If a family member genuinely helps in the business, for example with admin, answering calls, issuing invoices, booking clients, recording expenses invoices, preparing social media campaigns, then you can consider employing them. Nowadays, almost every business, even a general construction company, has an online presence and plenty of admin tasks. Very often, a partner helps with day to day business responsibilities. Maybe you have adult children who could benefit from work experience and training. And if they don't have another job, they may have their own unused personal allowance. Employing a family member can help tax wise, especially if the other person has unused allowance or earns in a lower tax band. Even if they already have another job, it can still be beneficial. Not everyone knows that national insurance is calculated under slightly different rules than income tax, and if the jobs aren't linked, there can be a separate national insurance threshold for each job. That's why splitting income between family members, even if they have other jobs, can often bring significant savings. But of course, it has to be a real work, a realistic wage, and properly processed through payroll. Outsourcing. If you were planning to outsource something anyway, for example, advertising, building a website, video editing, IT services, admin, bookkeeping, it can be worth doing it before the end of the year. Not because you want to spend money, but because it's a cost you would have anyway. And right now it can reduce your profit in a current year. The most important rule: don't spend money for no reason. Don't make expenses just to reduce tax. Because tax works like this: if you spend £100, you don't save whole 100. You only save the tax portion, for example 20 or 40%. So if you spend £100 to save £20, you've effectively lost 80. Better to have that 80 in your pocket than buy something you don't need. To summarize, first calculate where you stand, your profit and estimated tax. Make sure all your costs have been included. Then decide whether it's worth bringing some expenses into the current year or whether the tax benefit would be bigger by keeping some expenses for next year. If it makes sense, check if you can bring forward certain purchases, invest in equipment, courses, an advertising campaign, or a refreshed company image, like a new website. And in the longer term, consider whether it might be worth employing a family member in your business. And remember, all expenses must make business sense. They must be needed for the company or realistically bring benefits to the business. There's no point spending 100 just to save 20 in tax and buying something you don't need. That's simply a loss. Better to keep the money even if you pay higher tax than to have no money at all. If you're not sure which of these options make sense in your situation, it's worth calculating it individually. Every business is different, and what works well for one company won't always be the best choice for another. At Safi Advisory Services, we provide comprehensive accounting for UK businesses, both self-employed individuals and limited companies. We don't just help with tax returns, we also help you plan ahead so you don't overpay and you stay fully in control of your business finances. If you need support, get in touch with us. And if this material was helpful, subscribe and share it with other business owners who could benefit from it. Thanks for watching. See you next time.